The S&P 500 has posted consecutive years of 25% gains. It's been an incredible run, and sometimes when we see those kinds of results, people quickly forget that prices don't always go up. Corrections are normal, and they're healthy. It's part of the journey, and we're going to talk about that next. Hello, welcome back to Wealth Wednesday, our bi-weekly show to help you make better decisions about money in your life. If you'd like to catch up on past episodes, visit our YouTube channel. That's at Commonwealth Financial. You can also find us on the web at cfswv.com. And if you like this episode, please hit that like button and feel free to subscribe to our YouTube channel. Welcome back. Today we are talking about stock market corrections and, most importantly, how to stay mentally prepared when the markets do take a dip. I'm Neil Watson, and joining me today is Michael Cease from Parkersburg. Between the two of us, we have nearly 60 years of experience guiding clients through market declines. Mike, let's start with some basics. What is a correction, and how does it differ from something more severe like a bear market?
Well, Neil, a correction is defined as a 10% decrease in prices from the market's high. This is also known as a pullback sometimes in our industry. Based off historical data, this usually happens at least once a year. So it's something that does happen on a regular basis. It never feels good, but it happens. And then also you have what's called a bear market, and it's defined as a 20% decrease from the market highs. Based off historical data, bear markets happen 1 out of every 3 to 5 years on average. An important thing to remember is that this is normal. These pullbacks or corrections or bear market downturns, they're all normal. This happens in just the basic course of investing. In long term, it's very healthy for investors to go through these things.
So after a couple fantastic years like 23 and 24, it can be easy to be drawn into feeling overconfident. So I looked this up. This is the first time since the late 1990s that stock prices have posted back-to-back gains of 20% plus. It doesn't always go up and to the right. And here's a couple of my favorite charts. The first, calendar year corrections. We're going to go back to 1980. And during a calendar year, the average in-year price reset is 14%. Last year, it was only 8%, and the year before it was about 10%. But the important aspect of this, even with those adjustments, stocks have posted positive returns almost 3/4 of the time. The second chart we're going to look at today is bear markets since World War II. Since the end of 1945, we've seen 15 bear markets. At the beginning of 1946, the price of the S&P 500 was $17.36. And at the end of December last year, it closed at $5,881. So even despite all of those bear markets, and some of them extremely severe, we've still seen a significant increase in prices over time. And this doesn't include dividends, by the way. Mike, stocks do what they do. Over time, they go up, but those upward trends are often interrupted by moments of sheer terror. And that poses one of the biggest challenges to long-term investor success. After a couple of fantastic years, what should people be doing to prepare themselves for what is actually going to happen?
Well, we've really broken it down into 3 things that people should do. Number 1 is focus on a long-term plan. Investing is not about the next day, the next month. It's about investing over a time period. It may be 10, 20 years down the road. So don't get hung up on those short-term movements in the market. It's just a healthy part of the market. Number 2, I tell people this all the time. I'm sure you do as well, Neil, is don't check your accounts every day. It just adds more stress. And, people see their account go up one day, down the next day, and all of a sudden they think everything is horrible. Check it, monthly. We have some clients, the happier ones, it seems like, that they don't even look at it but every 6 months or a year. So it's a long-term investment process. Number 3, try to go back and remember and keep telling yourself why you invested in the first place. I mean, we're looking at long-term investment goals like retirement, college savings, or also just basically investing for the next generation. So those are my top 3 things you should do.
What's one thing someone watching can do today and take action?
Neil, that's a great question. So the first thing is you need to ask yourself, how does the investment side of your life impact your actual plan? So what we see people who work with other advisors that really don't have any type of plan or clear path of what they're trying to accomplish. So the next thing is if you haven't laid out that plan or a clear path, then what you need to do is sit down and focus on what you're really trying to accomplish and make sure the accounts are invested that way. And 3, the volatility is going to happen, and you need to really think about how that's going to impact both your plan and your short-term and long-term goals. So you need to really talk to someone, go through the planning process, and have conversations about, hey, there's going to be downturns in the market. How's that going to affect me? How's my portfolio going to react? And just have a better understanding of where you are today.
Right. And sometimes the idea that you have to be super aggressive may not really be necessary if you see that you can only need to earn 5-6% to achieve what you're really trying to achieve. So you can make adjustments from there as well, right? Thanks for joining us today. Remember, market corrections are part of the process. Stay patient, stay calm, and stay focused on your plan. If you like this video, please hit that like button and subscribe to our channel for future episodes. And if you'd like to speak to a financial planner like Mike or myself, you can visit our website at cfswd.com. Thanks for watching. Have a great day.